are you going to change with the changing times? So you might not know exactly how you're going to do it or how you're going to get to meet those goals, but you need to head in that direction. A budget helps you do that. So let's talk a little bit about the process. So when should the budget be done? The budget needs to be approved by the board before the beginning of your fiscal year. It's not going to be helpful to have a plan if you start the year without it. The budget isn't something that you can knock out in a week. It normally takes about 3 months from start to finish. This includes creating the budget, revising it, reviewing it, and then also ultimately having the board approve it. And when the board approves it, it's also going to need time to evaluate the budget. So you're not just going to go and present the budget to your board at one meeting and then bam, they're going to approve it and you move forward. They're probably going to need time to evaluate it, and they may suggest changes that need to be made. So there may be some back and forth there. So you'll have to take that into consideration as well. So if your board needs to approve the budget before the beginning of the fiscal year, when are they going to do this? So what is the date of the board meeting that's going to happen? Then work backwards to determine when you need to start the process. So again, if it takes on average 3 months, look to see when that last board meeting is that they are going to approve the budget, like finally approve it, and then work backwards so you know when to start the actual process. It's also best to do the budget in conjunction with the strategic planning. So when you go to start your budget, there's a couple different ways you can approach it. You can look at it from a top down or bottom up. So the first top down is when management determines the budget. So management basically goes in and says, here's what we're going to do, and this is how much money you have to do it. So that's really great because you have a limited number of people involved, it's efficient. However, there's also some negatives to doing it this way, that there is a lack of ownership by others because management is the only one involved. Again, so it's just management saying, hey, all of my program directors, my fundraiser, my HR person, this is how much you have to work with. We decided it, here it is, move forward. The opposite of a top down is bottom up. So in this approach, it involves more people. So it's going to involve the actual people that are in the programs and activities. So not only management, but you're going to involve some of those other people within the organization that are actually carrying out the programs and services. And this method is great because there is more buy-in from the people that are actually involved in the programs that are going to be using the funds. And likely the budget is going to be more realistic because you're getting information from the people that are actually working with the numbers. However, there are some cons to this approach as well. It's going to be more time consuming because you are going to have more people involved and then just a select number of people in management from the top down version. But again, you're going to get more buy-in. Using the bottom-up budgeting method also requires you to determine how far down you're going to go within the organization. Who all are you going to involve? So how many program directors or how many employees within the organization are you actually going to get involved in the budgeting process? So in looking at these two different methods, it's going to determine it's up to your organization which you choose. Depending on the size of the organization, how much time you have, which one of these approaches is going to be best for your organization. If time is more important to you and you don't have a lot of time, maybe you're going to go from the top down and just have a limited number of people, management prepare the budget. However, if it's more important to have buy-in from more directors, more employees, then you may choose the bottom-up approach. So regardless of which approach you decide to do within your organization, and one is not right or wrong, it's just totally up to the organization, you're going to have to decide the number of people that's going to be involved for the budgeting process. And again, this is going to vary on the organization's size and structure. Each organization will need to determine, if they take top-down or bottom-up approach. And then who is going to be involved? So some people that you might want to consider being involved is obviously your executive director or your CEO. They're the ones that are in charge of overseeing the daily operations. So it would be good to involve them. You may also want to include your CFO or your accountant, your main financial person there. They are going to be able to provide historical numbers, how things were done in the past. We can look to see how last year's actuals and how last year's budget, how we did. They are also going to maybe provide a little bit more of a financial knowledge as we prepare the budget. Your HR director may also be someone that you want to include. They're the ones that are in charge of, hiring employees and the benefits and that kind of thing. Again, it's going to vary on the organization as to these titles and positions that you have, but these are just kind of some of the ones that you may want to consider. A development director or your fundraiser, they are going to be the ones that have to go out and raise the funds. So it would probably be good to involve them. And then program managers. And this might be all program managers, it may be select program managers. Again, it's going to vary based on your organization, how your organization is set up, the size of your organization. But again, the program managers are the ones that are in charge of overseeing the programs. So they are going to be in charge of, spending some of that money. So you want to make sure that they have a buy-in, a say in that as well. For larger organizations, you may want to have create different teams. So each team creates their own budget, and then you combine all of those separate team budgets into one organization-wide budget. However, if you do decide to do something like this, you want to make sure that you do give them some parameters. For example, okay, this year we're expecting a X percentage of revenue decline or growth for this year. So that will give them something to start with. So they know if they need to decrease spending or if they can add some extra costs this year. Also, make sure that each team uses the same budget template, or you're going to get a wide variety of different formats, and it's going to be very difficult to pull that all together into one overall budget. So once we've decided who's going to be involved in the budget process, we want to go ahead and get started. So again, your budget should be driven by your strategic plan. And then your strategic plan should be driven by your vision, your mission, and values of the organization. We want these all to tie in together. The budget is about setting priorities, what we are going to spend our resources on. We don't want to think about it as restricting what we can and cannot do. Again, we want to think of this as an opportunity to address what our goals are this next year. Again, we want to determine what we want to accomplish. So some things to think about, big picture. What activities are we stopping? Are there any programs that we're going to discontinue or any significant activities? And what are the associated costs with those activities? Because those are going to be going away. What activities are we starting? And again, what associated costs are we going to be adding on because of these new activities? Do we need any additional equipment or tools to get there? So if we are adding some significant programs this year, do we need to go out and purchase additional computers for those program directors or providers, any other kind of furniture, or, what do we need in order to start this program up? Because that's going to be extra costs this year for us. We also need to determine if we are going to budget for a surplus, a deficit, or a balanced budget. So first off, you do not need to have a balanced budget. There are instances where you may want to budget for a surplus or a deficit. Normally, organizations with a balanced budget are just trying to survive. So they are trying to bring in enough revenue to cover current year expenses. And sometimes, with that, in this instances, when we're thinking about if we're going to budget for a surplus or deficit or balanced budget, we also need to think about multi-year grants. So those grants where you are awarded in one year, but you don't actually get the actual payment for the next subsequent years. So when we're doing the budget, we need to think about that, because A budget is not the same thing as cash flow. So if your organization follows the accrual basis, then your budget should be on the accrual basis. If your organization follows a modified cash basis, then it should be on the modified cash basis. And then again, cash basis to cash basis. So if you are on the cash basis, the budget may be more of a cash flow tool as well. But if you follow GAAP and accrual basis, then there's going to be some differences between cash flow and actual budget. So we just need to keep that in mind when we are budgeting. So again, those multi-year grants are normally going to generate either a surplus or a deficit because we're going to get the revenue in 1 year. That's when it's going to be recorded. However, the expenses are most likely going to be spent out in the following year. So sometimes you may want to budget for a surplus. So this is when you're going to have more revenue than expenses for the year. So for example, if you want to build up a reserve or rebuild your reserves, then you might want to budget for some extra funds. And just to note, best practices say to have 3 to 6 months of expenses, 3 to 6 months of cash to cover your operating expenses. Or maybe you want to have extra funds for a future capital purchase. Maybe you're planning on doing a capital campaign next year, and in order to get this campaign started, you want the organization to put in a set amount of money itself before it goes out and asks donors to contribute to the campaign. Or maybe you want to pay down some debt or start a new program. So these are all instances where maybe you want to start accumulating some extra cash for the future. You could also budget for a deficit. So this is when you're going to have more expenses than revenue for the year. So that bottom line is going to be negative. If you have resources from a previous year that you are going to use this year, that's when you're going to budget for a deficit. So for example, maybe you did in a prior year decide to budget for a capital campaign or a new program, and you started collecting all that extra cash. So this year is the year we're going to spend it. And so when we spend it, we're going to spend more than what we're bringing in for this year's current revenue. However, organizations that have a deficit budget, that's fine if you want to do it like on occasion, but that's not going to be sustainable. So you cannot always have a deficit budget. That's just one thing to keep in mind, that it's okay if you do it for a specific purpose, but you don't want to continuously have more expenses than revenue, because obviously your organization is not going to be sustainable if that happens. All right, so now let's get into actually preparing the budget. And first, we're going to talk about revenue. So I've just chosen to look at revenue first and then expenses. You can do expenses first and then revenue. It's totally up to you. There's no set rule on how you need to do that. So as we look at revenue, how much resources do we need to accomplish our goals? So again, we're looking at our goals and how they tie back to our strategic plan. Where does your organization's revenue come from, first of all? So in order to determine how much revenue we're going to need, we really need to look at our sources. So nonprofits can get revenue from a wide variety of sources. We can get donations from individuals and businesses and corporations. We can get grants from foundations. A lot of organizations will hold a special event or fundraiser. We also may get some government funding. We may provide some services where we actually charge a fee. So we get program service fees. Some organizations have large endowments or investments where we are going to be earning investment earnings. So that's going to be extra revenue coming into the organization. And then also we might get some just general miscellaneous other income on occasion as well. So as we're looking to see where our organization gets our revenue from, this is a good time to determine if your organization is relying too much on a specific revenue source or funder. So if you are, what happens if you lose that funding source? So we really don't want to have too high of a concentration from revenue from one single source or donor, because again, if something happens to them, that is really going to have a significant impact on our organization. And as we do that, we need to be aware of what's going on in our funders' environment. So how has the pandemic affected them? And consequently, how will that affect their support of your organization? So, you know, some companies, the pandemic really hurt them. And so maybe they're not providing as many donations to nonprofits this next year. Or maybe there was some government programming funding that you had received in the past, but now you're not going to get as much, or maybe you're going to get more. So we really need to understand the environment of our donors, so that way we can understand if there's going to be any changes on how they are supporting us as a nonprofit moving forward. Some things to consider when addressing the different revenue sources. So let's look at grants. Many nonprofits get grants. Are they reoccurring grants or are they one-time grants? So some organizations will receive the same grant every year from the same donor, from the same funder. So they can rely on, you know, every year they're going to get a $25,000 gift from Foundation A. That's great, as long as nothing happens to that foundation. But that's something to think about. Or you maybe just get a one-time grant this year and you're not going to get it next year. When you're getting those grants, are they restricted for a specific purpose? So if you get money that is restricted by a donor for a certain program or a set period of time, you need to make sure that that money is used for that restriction. So the way that you ask for funding affects what you can use it for. So if you are applying for restricted grants, you have to use it for that restriction. You won't be able to use it for operations. So something to keep in mind when you're going after grants. Contributions, that's another big one many nonprofits receive. Hopefully you have a good donor management system that you can determine, you know, you can look at things like the number of unique donors, the average donation per donor. So you can kind of look at historically, where have we been? You know, who have we gotten contributions from? How much have they given? What's our average individual contribution? That type of thing. Individual contributions are probably the most difficult to determine, especially if you have multiple smaller donors. But when you're preparing the budget, you need to make sure that the contribution amount is reasonable. So is it reasonable to say that we are in our budget, we are going to get $500,000 of individual contributions, when really the highest that we've ever gotten from individuals is only 100,000. So not really reasonable there. So we want to, again, go back and look at our historical data to see what types of support we've gotten from those individuals, and then kind of base this next year on that. Some organizations receive revenue from memberships. So if you do receive memberships, how many members have you had in the past? How many are you expecting to have this year? Has there been a decline in membership, or has membership grown? Are you expecting to change your membership rate this year or decrease it? So again, these are questions to ask. Earned income. So, you know, some organizations will provide services and in return will get paid for those services. So when you're determining how much to budget for your earned income next year, you want to think about the services that are creating that revenue. Are you going to continue with the same type of services? Are you going to be adding services? Are you going to be decreasing services? Will you increase the fees? Again, things to think about. Many organizations will have a fundraiser. So every year they hold a big gala or dinner. Are you going to hold that again this year? Sometimes events can become stale, especially if it's the same thing over and over again. Now, not all, you know, sometimes it's a great annual event, get lots of people to come. So, you know, has your special event become stale? Do we need to change it up a bit? Maybe we need to, you know, change our location or change the timing of it. And if we do that, how is that going to affect the amount of money that we raise from the event? Also, with the pandemic, many organizations have had to adapt on how they hold these events. So many have gone either virtual or to a hybrid method. So how is that going to affect your events going forward? How is that going to affect the cost? how is that going to affect the amount of money brought in from those events? And then finally, investment earnings. So for those organizations that do have large investments or endowments, what is the market doing? So if the market is going down or expected to go down, then you're probably not going to have as much earnings off of these accounts as maybe when the market is in a better position. Also, will you need to make distributions from the investment account during the year? So if you're taking money out of your investment account, then the balance left is going to be lower. And so there's not going to be as much in there to earn earnings on. And so the investment income will be lower than it had been in the past. So then moving on to expenses. What do we need to be efficient? So we need to have enough staff and equipment to run properly. So let's start by looking at last year's actual compared to last year's budget. So how did we do? Were we within budget? Were we over budget? Were we under budget? And why? Were some expense items just more than we thought they would be because unusual things happened during the year? Or did we just not understand the actual cost of a program or an activity? It's easiest to start with the fixed expenses because these are the expenses that don't change. So these are going to be like your rent, your utilities, your general liability insurance. These expenses normally stay pretty consistent from month to month and year to year. Some of these fixed costs are considered overhead or management in general. They aren't necessarily part of your program. They're not directly related to your programming, but they are needed to run your organizations. And sometimes these costs are looked at negatively in that since they aren't directly related to a program, they should be really low. But we need to kind of rethink that. These costs are just as important as program costs because without them, your organization wouldn't be able to exist. And when you're looking at these fixed costs, you also want to ask, are these really all fixed? Is there room for any negotiations? For example, the pandemic has taught us that people don't need to be at the office to work. So many organizations are reevaluating their office space. So do you need as much physical space, office space, as you did before? And maybe you don't. And so maybe there's some room in there to negotiate with your landlord and reduce the cost of your rent. Next, after fixed costs, it's easiest to move on to salaries. So your salaries and your related expenses, such as payroll taxes, health insurance, retirement, those are going to be most likely your largest expense category. So, and those are our people, and we want to take care of our people because without our people, we couldn't offer our programmings. So when we're looking at salaries, the first thing we need to address is number of staff. So are we adding staff or do we need as many staff? Are the right people in the right seat on the bus? Do we need to move some responsibilities around in between people? And if we do, how is that going to affect their salary? Are you giving raises this year or bonuses? Are you adding benefits that you didn't have before? Or maybe you're changing the amount paid by the organization versus the amount paid by the employee. For example, perhaps in the past, you've decided that the organization has paid 50% of health insurance for employees. Well, this year you're going to increase that to 70%, that the organization is going to pay 70% of the employee cost. So that's going to be an additional expense. And so you're going to need to calculate what that additional cost is on the organization as a whole. And then the final category of expenses are those variable expenses. And these are those expenses that fluctuate based on activities. So they're also the easiest to reduce because you have more control over them. These are costs like supplies, printing, maybe food if you have like an after-school program or a preschool, where the more kids that you have, the higher expense. So really you really want to look at each program to see how much costs what is the actual cost to run each of these programs? And if you're expecting an increase in number of participants, then these costs are going to go up. If you are expecting a decrease in participants, then these costs are most likely going to go down. When you're looking at expenses, don't forget the non-cash expenses. So these expenses are part of your operations as well. Without them, you wouldn't be able to run your organization. You're just not paying them out in cash. And if you include them in your budget, it's going to give a better, truer picture of the actual cost of running your organization. So these expenses are your in-kind, and that's actually both revenue and expense. So if something happened during the year where you didn't have the goods or services donated, you're going to have to pay for that. It also keeps the budget more consistent in comparing it to the actuals throughout the year, because and also at year end, because they are going to include the in-kind revenue and in-kind expenses. And if you don't include that in your budget, there's going to be a significant variance that you're going to have to explain every month, which you know what it is, but it gives a better picture to include those in the budget. Another non-cash expense is depreciation. So again, you're not actually paying out cash for depreciation, but it is an expense of your organization. So you want to make sure that you include that as well. Some organizations will prefer to separate out these non-cash items at the bottom of their budget, which is completely fine. It just kind of separates those out. So when the board or management, whoever is looking at it, okay, these expenses up here at the top are the ones that we are going to have to actually pay for. And then these down here at the bottom are non-cash. You can include them all together, or you can separate them out. It's totally up to your organization. So once the budget is prepared, you want to look back and ask yourself the following question. Does your budget reflect your organization's value? For example, if team building and culture is important to your organization, so you're saying that that's one of your high values, very important, but you don't have anything in the budget for team building, then it's not in line with your values. You also want to look to make sure, does your budget include enough infrastructure? Do you have enough computers? Do you have the proper equipment to provide your programs? Because if you don't, then it's not going to work. Does your budget align with your strategic plan? Again, everything should coincide together with your goals moving forward, your strategic plan. It really needs to go hand in hand. So your budget needs to directly associate with specifically defined activity that you're looking to accomplish. So for example, when we did our strategic planning and we said that we want to hire a new position, then we need to make sure that our budget includes an expense for that new position. Once the budget is prepared, it's going to need to be reviewed and approved by the board of directors. So once the board approves it, there may be instances where they have additional questions and they're going to say, hey, we really need to cut some of these expenses. If that happens, don't just do across the board cuts. This really doesn't take into effect inefficient or effective areas. So areas or teams that are performing really well are going to get discouraged, while areas that need to improve efficiencies won't be addressed. So we really want to look at cost by department. So where are the ineffective areas of our organization? What areas are outdated or maybe have inefficient processes and practices? One way to look at it is if you were going to start your organization from scratch, what programs would you start with? So what do you think is the most important program that you want to spend? You want to make sure that your resources are spent on this program. These are the expenses that you need to keep and then move forward from there and add on each additional program. As you're doing this, there may be some difficult decisions that need to be made. Don't let emotions make the decision. And also remember to always think strategically and go back to that strategic plan. What are our goals for the year? Just wanted to talk briefly about rolling budgets in multiple scenarios. Many larger organizations will utilize rolling budgets. This can also be done by smaller organizations. It takes more time and resources. So normally you see it done with larger organizations. So instead of going through an annual budget each year, the budget is updated every 3 months or every quarter. So These organizations are always forecasting out 12 months. They start with that 9 months that they have already been budgeted. They're reviewed, and those months are reviewed, and then an additional 3 months are added. So we always have 12 months. This keeps the budget current and forces management to review the assumptions made more often. So that's one approach that you could take if you want to be a little bit more current on the budget and also address any potential changes or challenges that are coming up in the next 12 months. Also, given the uncertain times that we are in, sometimes it's best to create multiple budgets for various scenarios. For instances where we aren't necessarily sure what's going to happen. So we're going to create a budget with the most likely scenario, but then perhaps we have a significant government grant that we're not sure if we're going to get that again this year. And that's a really big chunk of our revenue and our support, and that's really going to affect our programming. So maybe we'll create another budget if revenues decrease by X percentage. And by doing that, we're able to create a plan now that we can determine what costs will need to be cut later on when we're actually in that instance of finding out that, hey, we're not going to get that grant. Or, you know, maybe if we are not sure and we may get a new grant. So what would we do if revenues increase an X amount? What new activities can we take on? So just kind of looking at different scenarios so we can plan now for the future so we don't have to quickly make decisions if something should change. So once the budget has been created and approved, in general, we don't want to change it. We don't want to go back and revise our budget so the actuals are in line with our budget. We don't want to say, oh, well, we were totally off on that. We should probably go back and change the budget. We don't want to do that. However, if something unexpected happens that's going to significantly affect your operations, for example, you know, maybe, again, that large government grant that was unexpectedly not renewed, and we didn't do a multiple scenario budget, but we just did one budget, well, maybe now we should go back and amend our budget. Or if the organization's priorities change, the budget needs to change to align with those priorities. For example, maybe an organization sees a new need in the community and has decided to start a new program to address that need. So that need wasn't there when we originally did our budget, but now we see it and we really want to participate in that, and we think that we're able to do that. And so we should probably revise our budget to include that program. Before you go ahead and start revising and amending budgets, sorry about that. Before we go back and start amending and revising budget, we really want to determine what triggers should cause a need for the budget to change. So what's going to happen to say, yes, XYZ happened, so yes, we need to go back and amend our budget. And if we do decide that we need to amend the budget, we need to make sure that we keep the original budget column and then add a revised budget column and make sure to document the changes and the reason for the changes. So once we've prepared our budget, it's been approved, we're good to go, we want to start using the budget. Obviously, the budget needs to be reviewed each month as part of the review of the financials. So specifically, we need to look at budget to actual to see where we are. Because again, remember, our budget is our plan for the year. And so we need to, as we go along throughout the year, we need to compare where we're at actuals with how we thought we'd be the budget. So as we do this, why are there variances? Is it just that we didn't understand the cost when preparing the budget? Maybe a transaction has been miscoded. That happens, and obviously that would stand out as a significant variance. Or, maybe there was some possible fraud. Something got recorded and it was a fraudulent activity and it stands out because of the variance. In order to best use the budget throughout the year, you want to make sure that you don't just split your budget into 12 equal months. Your activities aren't the same each month. So the budget is going to be more useful and effective if the monthly budget amounts actually accurately reflect the monthly activity. And again, as I mentioned previously, the budget is not the same as a cash flow, specifically for organizations that are following GAAP or the accrual basis. The budget should be created on the same basis as the organization's accounting basis. So again, if you follow the accrual basis, then the budget should be on the accrual basis so that you can compare your budget to actuals, which are on the accrual basis. And again, as I mentioned earlier, the timing and collectability of revenue on the accrual basis can sometimes be confusing, especially when you have those multi-year pledges that are recorded in revenue in one year, and then you don't get the cash until the following year. So then the following year is when the expenses are going to be recorded. And so you just want to make sure that people clearly understand that, especially between the accounting and fundraising department, because sometimes when reports are run and compared with each other from the fundraising department to the accounting department, there could be a difference, and that could be the reason for that difference. So here is an example of an example of a monthly budget to actual. This is not exactly how it has to be, but just a sample. So as you can see at the top, we have our revenue and then our expenses at the bottom. The first three columns noted here to the left are actual for April 2021 compared to actual for April 2020. So here we are evaluating month over month, April to April, just monthly activity. And then we can see an increase or decrease between the 2 months. The middle section, we are comparing year to date. So we have year to date April 2021 to year to date April 2020. So again, we'll have 4 months comparing where we're at. And then the last 3 columns here is where we have our budget. So our 12/31/2021 budget. So that actually includes 12 months. So that's the whole year for 2021. And we are comparing where we are at currently as of April. So the actual year to date April 2021 column is being compared to the 12/31/2021 budget column. And then we're seeing where we are at over or under budget. And then the final column there is the percentage of the budget. So as of April 2021, we can see that we have used, or that we've received 22% of our foundation grants so far during the year. So just one sample that you can look at each month to utilize your budget to see where you're at. One thing that to look at too when you're looking at reports like this is, we talked about revenue concentration. So what percentage of revenue are we getting from each of these sources? We also always want to look at revenue expense variances from prior periods. So whether we're looking at month over month or year to date over year to date, why are we seeing those increases and decreases? And increases and decreases, those variances might not be bad. They may be expected, or sometimes maybe you're expecting to see a variance and you don't. So in those in those instances, you should question why. Also, you can look at the monthly expenses on a report like this, so we can actually see, okay, in April 2021, we had $44,160 of expenses. In April 2020, we had $39,000. So we can kind of gauge what our monthly expenses are. And then also the increase, decrease the net assets at the bottom line, that's really your net income, net loss for the year to date and month. So you can kind of see where we're at that point in time. Next is just another sample of a report that you could look at. And in this instance, we have through April, we have actuals. So January, February, March, and April show our actual amounts for our revenues and expenses. But then May through December, it hasn't happened yet. So those are kind of our estimated amounts based on our budget of when those items are going to occur. And then we can come up with our total for the year. So first 4 months are actual, we know what happened. Then the following 8 months, those are not actual yet, those are estimated, those are our forecasted numbers based on our budget. So we include all of those together, and then we compare what our budget says, and then we can see where we're at over or under budget for that. Just Just another way to look at it. Again, there's all different types of reporting that can be done and ways to use your budget. It just depends on what management wants to see and what is important to them each month. And then finally, just wanted to include kind of a summary of budgeting tips for your organization. When you're preparing the budget, make sure you include input from various people within your organization. They may have ideas for new ways of doing things that haven't been thought of before. Obviously, you hire smart people for your organization, so you want to use them. If you have uncertainties of the future of the next year, you may want to consider creating multiple scenario budgets. Make sure your budget follows your accounting. So for both basis, which we talked about, if you're on the accrual basis, make sure your budget is on the accrual basis, but also make sure that you're using the same accounts. So for example, in your general ledger, if you have one line item that says contributions, then you want to make sure that you have one line item on your budget called contributions. So that way it's very easy to compare budget to actual, as opposed to having a GL account that says contributions dash individuals, contributions dash corporations. You're going to have to add all those together to compare them to what's actually in the budget. And that's just going to be more time consuming and is going to make it more difficult when you run those budget to actual reports every month. Making sure that you're using the same accounting for both your budget and your general ledger also is going to make it easier for when you input your budget into your accounting software. So many accounting softwares such as QuickBooks provide the opportunity for you to input your budget into the system. And then that way it's much easier to run reports. I know there's also other types of, you can use Excel, or there's other additional software budgeting software out there. But if your accounting software already provides that, that's going to be the easiest and most efficient to just import your budget into your accounting software. Once you have created your budget, make sure you communicate to all stakeholders. You can't expect them to follow a budget that they don't know or don't understand. Only amend your budget under unusual circumstances. Just because our budget doesn't match our actual, we don't want to go back and actually change it. There's a reason why we created that budget in the first place. There's a reason why we put that amount in there. And so that was our plan for the year. So we want to make sure that that's the plan we're following. And then we can question and find out why maybe our budget doesn't align with actual during the year. Your budget must coincide with your strategic plan. It's going to help you meet your goal. Utilize the budget as a tool. So the budget is a living, breathing document. Don't just create it and put it on a shelf. We really want to bring it out and consistently use it throughout the year, not only to compare budget to actual to see where we're at, but also to make sure that we are meeting our goals with those strategic planning. Thank you for attending today's session. If you have any questions, please feel free to contact me. My contact information is here on the last slide. Also, I encourage you to visit the nonprofit section of our website